Thank you so much for joining our NFIB Pennsylvania webinar on small business breakups and determining the value of your business. If during this presentation you have a question, please hold it till the end because we will be doing a recording and then we'll be happy to answer your questions. And if anyone who watches this recorded wants to email me your questions, we'll also follow through. I'd like to thank our sponsors, if I may, on the second slide. They are McNees Wallace and Nurick, who also provided our primary presenter today, Members First Federal Credit Union and Capital Blue Cross. Now let's get right to the topic. I'm going to first mention who our two presenters are. They are Paul Helvey. He's chair of the Family Law Practice Group at McNees. And also we have Greg Crumling of Crumling Consulting in York County, Pennsylvania, who's a forensic auditor. Paul, if you could start out, take it away.
Well, as Suzanne had mentioned, I am the chair of the Family Law Group at McNees Wallace and Nurick, and as a result, the bulk of the time that I see business valuation issues arise are in the context of a divorce where one of the spouses wants to get a handle on the value of the business. Actually, they both want to figure out what each of them will get from the business going forward. However, there's multiple other situations in which determining the value of a business is important. Greg, could you just give us some other examples where you need to know the value of a business, at least where people have come to you and said, hey, we need to figure this out?
You mentioned family law. Two other big areas that I see valuation needs are in buying and selling a business. Sometimes that's because the parties have a dispute or no longer want to be partners together. Other times you're selling the entire business, but there's a need for the value. We will often see the need for valuations in estate planning or gifting of a business interest or for death tax filings. The taxing authorities will require that a valuation be put on the business as well. There could be some other needs, employee stock ownership plans or other ways of awarding employees with compensation. But typically the three big areas that I'm involved with that I often see valuations are the family law, matrimonial arena, estate planning or gifting, and some form of buying and selling the business.
So the next slide that we have up is sort of what to expect in the appraisal process, and generally what you will see from our little flow chart here is that you will contact your business evaluator and will get some type of perhaps engagement letter or proposal from them. Ultimately, you will probably end up with an engagement letter indicating exactly what the scope of the project is going to be and what it is that's being valued. The next step is going to be information gathering, and that can be quite extensive. And generally, a business evaluator is going to want to start by getting probably 5 years of financial information that's going to include tax returns, financial statements, things of that nature. Then there's going to be research and analysis, and many, many times that will involve the business evaluator interviewing the owner, going out to the site, and actually examining the business operations, and then ultimately preparing a report. You can see in the lower left-hand corner the words client involvement, and that is there because the client knows more about the business if they're the business owner than anybody else does. It is critical for the client to be involved in the process. This is not simply a situation where you just say, hey, business evaluator, you go off and you do your thing. In many, many instances, the input of the business owner is absolutely critical. On the next slide, what you will see are the three approaches that can be used by appraisers. And Greg, if you would just touch on the one on the far left and the one on the far right, and then we'll drill down quite a bit more on the income approach.
Certainly. The market approach generally has two methodologies within that approach. One is taking publicly traded companies and the price to earnings multiples that they are trading at and applying that to your subject company or the business that we're valuing. Typically not something we see, especially in valuing small to mid-sized businesses. They're just not comparable. How do you compare a very large company with hundreds of millions of dollars of equity and significant sales across the country or even across the world to our small businesses that we're typically valuing? The other method within the market approach that we do often see is what we'll call the transactional method or merger and acquisition method. Similar to the guideline public company, you're finding other businesses that have actually been bought or sold and looking at what they sold for. Similar to what we do with real estate. You find property that is comparable that recently sold and you use that as a benchmark. Same type of a process here. So we're actually tapping into databases, looking for other businesses of a similar nature. But within that market approach, typically you're going to see it as a sanity check or as a second methodology to what we're going to really drill down on, the income approach. Not to discount the market approach, it has its places, but more often than not, it's going to be that secondary or sanity check method.
And Greg, just if you could make a quick comment on these sort of rules of thumb or multiples that I typically hear from business owners saying, hey, everybody in my business knows that the value of this business is going to be X times the annual earnings of the business, or some other rule of thumb. Just a quick comment on those if you could.
Yeah, we refer to those as our street multiples in the slides, or rules of thumb as you've used. I would just say be very cautious. More often than not, you're left with more questions than you are definitive answers by applying those. Some of these rules are very old, dated, so they may not even be valid today to start with. But then, okay, you apply the 1 times revenue multiple, and then what do you do? Do you subtract debt? Do you add any assets of the business? So they're meaningful. They're something that I will admit I consider, but they're definitely not all that helpful more often than not. If you're going to use them, I would just be very careful.
And the other approach, the one on the far right here in this slide, is the asset approach. Just a quick comment or two on that, if you could, Greg.
We didn't do a slide for the asset approach. It's fairly straightforward. It's typically for businesses that are capital intensive or that are holding companies. It might be the entity that owns the real estate from which the business operates. Under the asset approach, you're going to typically go out and have someone appraise the business as far as appraising the assets of the business. What's the real estate worth? What is the machinery and equipment worth? You're going to add up the individual assets, the cash in the bank, the accounts receivable, the appraised value of the assets, subtract its liabilities. Typically, it's used for, as I mentioned, asset-intensive businesses or holding companies, or where we'll see it some other times is a business that is not doing very well, is worth more dead than alive. If you were to sell off its assets and liquidate it, you would end up with a higher value. We have to consider the asset approach as a floor value. It's generally the minimum value that you could sell the assets for, but for a profitable, ongoing operating business, generally not all that indicative.
All right, let's move on to really the approach that I see used most often, which is the income approach. And Greg, I think it would be helpful if you just give us a general sense of what the income approach is and how it's utilized.
I'll bring up 3 terms from our slide that we'll come back to and talk about. The income approach specifically talks about the profits, the risk of the business, and the growth aspect opportunities for the business. So with an income approach, we are determining what the income of the business is. Generally, we're more concerned about cash flows than we are taxable income or some other form of income. You can spend cash. It's hard to spend income if it's not really cash or liquid income. So we're generally going to be focused on what the cash profits of the business are. We will then go and develop what we call a capitalization rate or a discount rate. Within the income approach, there are 2 main methods of valuation, back to my distinguishing between approaches and methods. Under the income approach, you have what we will call the capitalization of earnings method. Capitalizing earnings looks at the historical operations of the business. And we have the discounted future earnings or discounted future cash flows method. And based on its terminology, future, we're looking at the future operations of the business. So we are coming up in either case, the earnings of the business, whether we take the past earnings, deem them to be indicative of the future, and use the past as a part of our valuation, or whether we develop forecasts of the future and consider the future to be more indicative if the past is not. Again, you're dealing with, first of all, the earnings or the profits of the business, and then you are developing this capitalization rate or discount rate, which looks at the risks of operating the business. Typically, you're going to see within the income approach, the capitalization rate or the discount rate determined under what we'll call a build-up method. I talk about risk. The concept is, what is the risk of owning a business versus an alternative investment? We start with a risk-free rate. As risk-free as you can get would be investing in the federal government, hopefully not having to wake up in the morning, you get your check every day, they just send you this interest.
And Greg, from a layman's standpoint, generally I think of this as the riskier the business, the greater the return on my investment I'm going to require in order to get involved in it. Is that a fair concept to be applied here?
Yes, very well said, Paul. The risk issue deals with, to your point, risk-free, don't have to really do anything. I don't own my business. I don't have to manage it. I can invest in the federal government and I can get a return on my investment. Not a great one today, but call it a 2.5%, 3% return on my investment. If I want to invest in the stock market, I'm taking more risk. If I want to own my own business, I'm taking more risk. So the greater the risk, the higher return I want on my investment, the higher the profits need to be to justify the price that I'm paying. So yes, absolutely, there is a risk-reward concept. Higher risk, lower value, lower risk, higher value. Looking at it from a profit stream, higher profits, higher value, lower profits, lower value. So there's this profit is one side of it, risk being the other.
So let's just back up a little bit, because we again talked about, the earnings of a business and the profits of a business, and as I've learned the hard way, there's a lot of different ways of slicing that onion. And let's just take a classic example where you have someone who owns a business that also works for the business, probably runs the business, and they receive, in addition, if they're the sole owner of the business, in addition to the profits of the business, they also get paid a salary in many, many instances. Is it necessary for you to examine the salaries that are being paid and do what we call normalize them in order to really get a handle on the true earnings or profits of a business?
You're reading my mind, Paul. The normalization process is absolutely critical to coming up with what is the profits of this business. Pretty well accepted, generally accepted, and even the IRS knows that people are adverse to paying taxes. People will do what they can to avoid tax, and to do that, you reduce your taxable income. Some people will do things that are not necessarily appropriate and sometimes get the IRS in an uproar, and others will do everything they can that is legitimate to maximize their tax deductions. But certainly compensation that you touched on is a critical example. We will often see within the small business a need to adjust the compensation that the owner is actually paying himself or the spouse or the children. or all of them in some cases. Sometimes it's an increase in the compensation level that is being paid. S corporations are an example, not to get too deep into the weeds, but an S corporation income passes through to the owner on their personal return, just like their salary would. If it's a salary, that comes with Social Security and Medicare taxes. Sometimes the business owner will pay themselves a minimal salary so that they don't incur Social Security and Medicare taxes, knowing that the same net taxable income gets reported on their personal return anyway. They may be worth a whole lot more than that salary they're paying themselves. I would increase the expense in that case.
And let's just look at the converse. Let's say you have a C Corp. Might a business owner be inclined to do just the opposite of what you said, and why would they do that?
Yes, absolutely. The C corporation pays its own tax, so it would like to have the least amount of taxable income possible. If the business owner, in this case, owns 100% of the company stock, they can do whatever they want. There isn't any other shareholders that they're accountable to, and they may say, I'm going to pay myself a big bonus at the end of the year equal to the profits that the business has above what my normal salary is, and take the corporate income down to zero so that they don't have to pay tax on it twice. With a C corporation, the C corporation pays tax, and then to get those profits out of the business to the business owner, there is typically a second round of tax. So from a C corporation perspective, there is a definite motivation to minimize profits, whether you do that through salary, high rent. Rent is another one where we will often look, especially if the property is owned by the same owners, whether it's personally or in a separate entity, we will want to adjust rent expense to fair market value, arm's length rent.
And for both of these normalization, I guess, processes that are utilized, am I correct in saying that the general concept is that if I, as a potential buyer of the business, were to buy this business and not run it myself, how much would I have to pay somebody to do the job of the people that are currently doing it? Is that generally the question? Or if I was going to have to rent this property, in the rent example, what is the market rent rather than whatever it is these folks who decided at a less than arm's length transaction?
Yes, in the normalization process, there's two broad categories. Those that are controllable and those that are uncontrollable. Within the controllable process, what's fair salary, what's fair market rent? Typically what we're valuing is, if I were the absentee owner of the business, if I owned the stock but I did not work there, I did not manage it, what would I have to pay someone else to do that for me, or what would I have to pay in rent expense? So we're going to be looking at what is the true costs, if you will, to run that business at an arm's length process. I also mentioned some normalization adjustments that are not controllable. As the buyer or the seller, either one, I'm going to be looking for, let's say we had a fire in our manufacturing operation that caused us to be shut down for a period of months, as well as a lot of costs to do the repairs. That would be an adjustment that I would make as non-indicative of the true future and the true profitability of this business. If you happen to have a union strike or something like that. So those examples of non-controllable, non-recurring types of events would get normalized, as well as those items that are controllable by the business owner.
And again, I think the concept is we're trying to predict what's going to happen in terms of the profitability of this business on into the future. So if you have an expense that may have come up in the last 5 years, when you're looking at the income that is not likely to recur, would that be something that you would tend to pay less attention to than an expense that you know is going to happen year in, every single year?
Yes, and to the extent that that expense is captured in the historical income levels, we would remove it to get to a more representative income level of what really would have happened had it not been for that non-recurring unusual event.
So let's say that I'm a small business owner and I run the business out of my house, and I know that I'm paying, as the business owner, maybe, let's say I'm paying $2,000 a month on the mortgage of my house, and I'm taking that $2,000 and all of it and calling that an expense of the business. And that's just one of countless examples where somebody may be running some of their personal expenses, and a lot of times it's not 100% of them, but some portion of their personal expenses through the business. How is that dealt with? Because it seems as if you're doing that, you're going to lower the income of the business, which could ultimately affect the valuation. Is that something that you pay a lot of attention to and look at?
To answer your one question, how is it handled delicately? And the reason I say that is the individual that's doing that has potentially crossed the line with the taxing authorities. Do you want me as the valuator to put out there in bold writing that I am making a normalization adjustment because this individual business owner deducted all kinds of what I deem to be unnecessary business expenses that were really personal in nature? Again, their mortgage, the utilities at their house, things like that. That whole area of personal expenses is a big one that gets looked at, especially in what I will call our small to medium-sized businesses, where you have one or two owners. They are paying country club dues, and they are doing all kinds of extra personal type expenses being paid through the business that not only would the IRS have an objection to, but are they really appropriate for business? Are they necessary for this business? But then you also talked about the house again, to use that one. I operate the house or my business out of my home. The buyer may recognize that they need to have some sort of an office as well. Their home may not be set up for it, or they just don't do very well working from home and they need to have an office to go to. I'm deducting a portion of my rent, or excuse me, a portion of my mortgage. How does that expense compare to what a rent expense would be? So there may be some legitimacy to the amount if a third party were truly buying the business. All things that we have to look at throughout our valuation process.
And where is it that you go to get a handle on whether there is money flowing out of the business that may not be necessarily mission critical to the business? Is the general ledger one of the places that you would go?
It could be. Certainly, depending on if it's a dispute, what side of the dispute I'm on. Am I working with the business owner who is more in tune with the financials of the business, or in our family law cases, am I working with the spouse that is the business owner? Certainly I'm going to be asking them these questions and helping have them explain to me, helping make this picture something that is realistic. Are these necessary business expenses? We're going to be looking at our historical trends. We talked about 5 years of historical information generally. We'll be looking for the number that spiked in any one particular year or dropped dramatically from year to year. And then if we need to, certainly we will be digging into the general ledger, looking at the detail invoices, things like that. Typically in that type of a case, we're getting into something that is truly a litigation perspective, a lot of discovery, not to get into the formal process, but a lot of back and forth with the attorney and additional information that we would need.
And unfortunately, because I kind of live in the world where these cases get litigated on a fairly regular basis, we do spend a fair amount of time and energy looking at that general ledger. And there are certain categories within that general ledger that we pay more attention to than others. entertainment is one that I tend to look at very closely. Some advertising expenses is something that we look at very closely. Are there, if you could make any comments on those two, or other places that you look at where you just say, these are places where we may pay a little more attention and make sure that money isn't leaking out of this business that's not absolutely necessary?
You identified two other ones that we often see. You mentioned entertainment. I'll say travel and entertainment, automobile expenses, auto and truck expenses, and professional fees. Believe it or not, the business owner will often feel justified in paying their divorce attorney, as an example, or their estate planning attorney fees through the business because they're trying to protect that large asset. So again, not getting into the legitimacy of the deduction as much as, is it a recurring normal expense that they would have year after year, and it's not truly indicative of the profit of the business, we would remove that expense.
Another thing I've seen with some regularity, particularly with family-owned businesses, is that they may have family board meetings that can occur in all sorts of neat places throughout the world, but may not be necessarily critical that the business spend that much money for the board to get together. Is that another thing that you see out there?
Yeah, very true. Good point. I mentioned it earlier as another example, children. I've had the businesses where the 4-year-olds are cutting the grass or something and getting a paycheck to do it. So again, you're going to have to ask a lot of questions and dig in a cost-benefit context. There's a lot of discussion of how much digging we're doing, especially if we're working for the non-business owner or the business owner that may not be as in tuned with the financials as the other, because it can get very costly. This whole concept of a forensic analysis tied to the business valuation is a very costly endeavor.
Another challenge that I've come across on more than one occasion is where a business within the the 5-year look back period that we typically look at may have spent a significant amount of money on capital acquisitions, buying new equipment, upgrading their equipment, doing things of that nature. On the one hand, it's almost certainly an appropriate business expense, but on the other hand, it's something that may not happen every year. How do you deal with that?
A couple of ways. If that were the only issue that were impacting the future, being different, if you will, that they will not have the same level of future capital expenditures, then we can probably still use the capitalization method, the method that looks at history, and we will just make some adjustments for the cash outflows won't be as great, the depreciation expense would be a little different. If, however, they were buying all of this new equipment because of a new product line or an expansion in business, and now all of a sudden revenues are going to be different as well, now you might be getting into the forecast of the future and this discounted future earnings methodology. So something like that is one of the items we try and identify early on in part of our information gathering process, the analysis that we do, and then as part of the interview with the business owners, flush out whether or not this is something that are we replacing an obsolete line, or are we really expanding our business, which will help us then identify which methodology is going to be most appropriate.
And we also say, okay, this is a piece of equipment. We expect that this piece of equipment is going to have a lifespan of, or I can reasonably expect to use this for X number of years. And so when I'm projecting into the future, maybe I say, okay, every 10 years, this is the type of expense this business can expect to incur.
Yes, the relationship between cash outflows for capital acquisitions associated with debt payments, did you finance the acquisition, as well as the depreciation need to mesh themselves within the valuation process. So even though you buy an asset that for tax purposes you can write off immediately if you take advantage of some of the special tax rules, or depreciate over a 5-year period, if it truly has a 10-year life, we may treat it differently from the value of the business than what you would see as your typical tax depreciation expense.
So just before we leave the income, if I go to a corporate tax return and I see that, or an individual tax return on an S Corp, and I see that the profit of the business is X, I think you've made it pretty clear I can't just rely on that number right off of the tax return. That may be a starting point, but that's not a number that you're going to just say, oh, I have the number now, I can just carry on. There's going to be much further analysis, is what I'm hearing you say.
Clearly, more often than not, there is definitely going to be more analysis that is needed as opposed to just taking that number. And again, it goes back to something we talked about earlier. Is it just taxable income, or is it taxable income before depreciation? Do you add interest expense? So there is a lot more to be done than just simply the tax return and even 1 year of the tax return.
So let's say that we have a business, and after we do our analysis of the earnings, we come up with $100,000, and that's the $100,000 represents the earnings or the profits of the business. We will then apply the capitalization rate to that number, correct, in order to come up with a business value. And earlier on you had said, look, we can either look at capitalization of earnings or discounted future cash flows. Can you give us a handle on what, again, just using this sort of $100,000 number, what is the range of cap rates that you might see in various different businesses?
One of the challenges, and I will answer the question, one of the challenges is what is the debt of the company versus the equity of the company. There's a little bit of a difference between 100% owner equity invested in the business, and therefore I, as the owner, am at risk basically for 100% of what the ownership interest is worth. If, however, I'm able to borrow money from the bank, I've kind of shifted some of that risk to the bank. That assumes, of course, I don't have personal guarantees on the bank debt. If it's a smaller business or a business that's just getting started, more often than not, the banks are going to want personal guarantees from the owner. So arguably, you're on the hook for all the debt anyway, even if it goes bad, because you have all the personal guarantees. Typically, go back to my build-up approach that we talked about, from a cost of equity perspective, what return should I get on my equity investment in the business? Let's say risk-free is 3%. The stock market has outperformed the risk-free bond market by about 6%, so now you're at 9%. There have been a lot of studies done that truly suggest the smaller the business, the greater the risk. So there's a size differential. For the smallest of the smaller type businesses, you might have an additional premium of another 5 to 6%. So now you're at 14 or 15%, depending on the industry of the business. If they're in the nuclear waste industry, they've got a lot more risk. If they're in some other more stabilized industry, it may not be as great of a risk. So you may have an adjustment for that. You've got specific company risk. Are there issues associated with lack of management depth? It's really the owner and his team, but it's the owner that drives the business. Typically, you're going to be looking at a return on equity for a small type business, maybe 18%, more realistically 20 to 22, and it wouldn't be outlandish to see 25 or even a little bit higher than that. So somewhere in that 20-ish range, again, it could be a little lower, it could be a little higher, but 20 to 22 for your typical small business.
And just to kind of dumb this down a little bit, let's say we got $100,000 in earnings on an annual basis, and you're saying that we may be in that 20% realm, and I understand I'm asking to make a broad generalization here. Would that yield a $20,000 value for the $100,000 business?
No. What that is saying is that the $100,000 of profit should get me a 20% return on my investment. So think of the capitalization rate as the opposite or inverse of a price to earnings multiple. So if you use, I appreciate using 20% because it makes the math easy. If you take 100 divide by 20, you get 5. 5 would be your earnings multiple. So in this case, you would take your $100,000 of earnings, multiply that times 5, and that would suggest that the value of your business is $500,000. Or if I have a $500,000 equity investment in my business and I should get a 20% return, I should get a $100,000 return, 20% of $500,000.
And are there other discounts and factors that you also have to take into consideration? And once you've done you've built up your cap rate or you've established your capitalization rate, are there other things that you may look at? For example, let's say that I only own 10% of the business rather than 100% of the business. Would that affect your valuation approach?
Yes. 2 big discounts we often see. One is this lack of control or minority owner. Again, without getting too deep into the details, if I only own 10%, I can't control the business. However, if the 2 other owners are 45 each, so there's 3 of us that own the business, all of a sudden my 10% interest looks pretty good because I am a swing vote. I can jump in there and be part of the decision-making process by aligning myself with one party or the other. So clearly, discount for lack of control is one. The other one that we'll see is discount for lack of marketability. Often within a small business, especially with multiple owners, well, only if multiple owners, there is a buy-sell agreement, or hopefully there should be a buy-sell agreement, or a partnership agreement that has provisions of buying and selling. There may be some restrictions on my ability to sell the business. Those clearly need looked at, and depending how stringent they are, may have discounts applicable to the value because I own 50% of a $500,000 business, but I can't sell it. So really, what do I own? There may be a discount associated with that.
And again, very broadly, what kind of ranges for the discounts are we talking about in terms of marketability and a minority or lack of control discount?
This is one of these questions that very broadly, 0 to 100. And I say that half jokingly, but the discounts can be all over the place. Typically, and I use that word very cautiously, you're going to see discounts that are somewhere in the 25 to 35% range. Certainly there are discounts that are lower, and there could be discounts that are higher, but typically somewhere in that 25 to 35% range is what I would say is normal.
Any other significant discounts before we move off of the discount topic?
Not necessarily discounts. There could be some issues associated with key person. If the owner is a critical one, you may have to increase your risk factors. There may be some small discounts associated with voting rights or lack of voting rights. But the 2 real big discounts are lack of control and lack of the ability to convert my ownership interest to cash or liquidity.
And just a minute or 2 ago, you had mentioned, taking a look at a partnership agreement. In many partnership agreements, they will contain or they will have a separate buy-sell agreement. It may say, hey, look, if you're an owner of this business, if you want to get out, you're going to get X number of dollars, or here's the formula that will be applied to determining how you get paid. Is there any need to have a business valuation if you got a buy-sell? Can't you just look at that and use it?
A lot of times I'll punt that one back to the lawyer. Is it a binding agreement? Is it the requirement to start there within the family law context, especially in the state of Pennsylvania where I practice? The buy-sell agreement is a factor to be considered, but it's not necessarily controlling. I'll let you play the lawyer and expand on that one. but there could be other provisions in the agreement that make it valid or not valid. One of the concerns I've often run into is, no disrespect to the lawyers, the buy-sell agreements are often drafted by lawyers who say, let's have a value done. Well, what does that mean? Does that mean fair market value? Does that mean we consider discounts or we don't consider discounts? They're not always defined very well specifically what they mean.
And all I can say is that in the context of litigation, particularly in family law, but in other litigation as well, the courts have pretty much said, yeah, we'll take a look at any of these buy-sell agreements. We will consider that, but if that buy-sell agreement is not in any way, shape, or form consistent with reality, consistent with what this business may actually be worth, we're not going to pay a lot of attention to it. Buy-sell agreements that contain formulas that are based on the earnings of the company are much more likely to be considered and taken seriously than a, hey, we don't really care what the company's making. If you decide you want to leave, it's worth $30,000. That's in the context of a divorce litigation where somebody may be saying, hey, this business is worth much more or much less than whatever that buy-sell agreement was. And many, many times I'll have business owners tell me, hey, look, we don't even have to worry about the value of the business. It's already taken care of. We got this buy-sell. And in many cases, that's just not the situation. Well, our time is just about up. I know that Greg and I have done full day discussions on business valuation, and this is just a little mini introduction to it in an hour. I do want to thank everybody out there for your time and attention. And if anybody has
Paul,
any questions, yes.
I was going to say, do you have a slide with your email if people did have questions? And if not, I can certainly connect them with you. There we go. Okay.
There's a slide
not
with
your
our phone
email,
number,
but at least some contact.
Yeah, and I will give my email address is P as in Paul, Helvey @ McNeeslaw.com.